Good morning, Jack Iyer. Good to be with you today, my friends from the YouTube world. I have a continuing teaching today on the banker's mindset versus investors' mindsets. So I want to speak to you on that again to differentiate a little bit the thinkings, and you can adopt them, or you can at least know where you are if you're an investor only. And but I found this to be very, very true. I am involved in the AIAclub.com. If you want to pull it up, it's the state of Alabama's Real Estate Investors Association. We own the name ALREA, Alabama Real Estate Investors Association. And in there, I've seen hundreds of investors come through in my leadership time, and I would say this is very, very much true from those hundreds of investors I've seen, even into the thousands that I've seen and met through our affiliation with the National Real Estate Investors Association. Going to those annual meetings and interacting, usually at least one, but oftentimes two times a year on a national level. We have interacted, and so I've been around a lot of real estate investors in my time, and so they think very much like this teaching I'm going to do for you today, and maybe you can, there's some pros and cons of, I guess, of each, but I like the banker's mindset approaching. The bankers want to stay liquid. They want to remain liquid as much and as long and often as they can be. They believe in carving out liquidity out of their investments, and I always was that way. Some you could say, well, you don't, you're not willing to risk as much as you need to in real estate or this kind of thing. Whatever, it wasn't my forte to go. I'm a pretty avid buyer now of investments, but I wanted to do it, and I wanted to pay it off as soon as I could. I didn't believe or like paying lots and lots of interest, and I just felt more safe and more comfortable when I didn't have to pay debt. And so, but commonly the investor's mindset is to accumulate equity in their investments. And in the subject of real estate, that often is just pure equity that is tied up somewhat inside your properties or in your real estate, and many go into great debt to do that, to get the real estate, and then you believe in the tenant, or whoever the tenant is, whether it be commercial or personal, is going to pay that debt off for you. It is one of the fundamental principles of real estate, is having somebody else pay that debt off. But I was not raised that way. Didn't have that mindset, to be honest with you. I wanted debt backed up by collateral. I felt more comfortable when I had that, and I always pursued that path down the road. So I'm going to share some of the principles this book, The Banker's Code, has today for you to help illustrate the mindset I had, and versus the mindset of common real estate investors. I've seen too many get into trouble with overwhelming amounts of debt, and to get ultimately, in many cases, ran out of the business because of debt. And if cash flow gets interrupted significantly for any reason, you can think of the many, many reasons that that can happen, including sickness and health and tenants not paying. A certain amount of them can cause significant hardship on the investor being able to make those payments. So but typically the banker is protecting themselves with reserves and cash so that they can lend off of it, and they do have some privileges in the government in that they typically can 10x their loans off of their capital, so it gives them a an ability to 10x the lending, and bankers never forget that they're in the money business, and they need they think in terms of hanging on to it, and you've got to convince them that before they give you money that you're going to pay them back. And so we become the, what would you say, the servant of the master, so to speak, and that's the banker, because as we learned in the last video, the banker makes and sets all of the rules. And you should, if you're the banker, you should set rules that are one-sided, yes, one-sided, so that you are certain to get paid or near certain, or you either got a recourse that's going to bail it out and still have the interest that you expected and perhaps more in terms of if you have to take those properties. In this case, if we're talking about real estate. So investors hang on to equity in their net worth. They measure themselves by equity in their net worth, and they like that. They tend to like that for periods of time. But you can see, as some of the things we've discussed, that it has more risk to it, and definitely if it gets out of hand and overwhelming, can be too great a risk. I think about a friend, Robert Kiyosaki, and how much the more he makes, the more he wants to borrow. And it's worked for him for a long time, and he's had enough assets and enough operation income to pay those debts. Obviously, we don't see anything in terms of great, but it can happen. I can tell you, I've seen it dozens and dozens of times in our RIA club. So be mindful, try to be prepared for it, and try to build reserves your own self. The banker wants investors to keep their equity because it makes the banker shift more risk to the investor and less to the bank. They need that proactive, protective equity to keep their loan safer by having a lower loan to value. So that's one thing. If you got steady payments and you're paying it down, yes, the banker really likes that and enjoys that because their loan is more and more safe and apt to be paid. You would have to say. I've seen mankind tends to only bail out, or often a certain segment will bail out when the debt is the highest and they have the lowest equity in it. We've seen loans, for example, where they'll loan 100% of the property value. Well, if they get behind or they don't like the deal, if inflation or whatever goes against them and the property's not worth as much as they paid for it, the tendency is much greater breach of that agreement to pay those payments, because it doesn't make any sense to them to be underwater on a loan and mortgage when their property is not worth as much as the loan. And so they walk off and leave it and yes, they suffer some credit hurt, but they will drop that type of loan if they see themselves underwater a lot. So there is no equity in that arrangement. It reversed and went the other direction on them. Investors like to own properties. Bankers use properties as collateral to secure their cash flow. They dislike owning them. So they want mortgages on the properties typically, and they want to control them with those mortgages, uh, and so the investor has they're trying to work down to own that property, just like me. I'm very much that way. Investors are in the landlording business, and bankers are in the money business. So bankers are in the money business. So if you're piling up assets for liquidity and stuff, where I'm very much into that right today, where I'm at very much, and I could have had a lot more maybe equity, but I did pull capital in cash as often as I could and tried to pile it up on the sideline. It made me stronger. It gave me more peace of mind. It made me more aggressive in a lot of respects, and it made me more solid and sound, I felt like, by doing that. And so still a landlording. I believe in landlording. I've done that. Banks do not do a good job, typically, landlording. They don't do a good job of managing and taking care of property. Typically they will try to get that property on the market and sell it. They'll even sell it at losses sometimes, just to keep it from going downhill further the longer they hold it. So we bought properties from short sales and things of that nature. They let go because of those. They're not good property managers typically. Investors generate cash flow by using bankers' money and owning properties, whereas a banker makes money by using consumers' money and collateralizing the mortgages they get when lending the money out. Okay, so that's typically the side of your different thought pattern that takes place between the two. Investors make a down payment to buy properties, therefore shift the risk away from the lender and onto themselves. The more they put down, we commonly think that that's a good thing, and it makes us stronger, and that is the better thing to do. But in actuality, it is not. The less we put down on the property that we can negotiate with the bank, the less risk that we have as an investor. Bankers require a down payment from the borrowers to shift more risk to the borrowers and away from the banker. So you can see in your mind that the banker has a partner in us, the investors, and the more they can encourage us to come with down payment money, the better off and safer the bank is, and the greater that partnership is. That partner is being the investor is at subject to loss if they lose it, which gives bank liquidity and profit that they can liquidate that property and sell it off. So just be mindful of the two different mindsets and there. Most investors are asset rich but cash poor. Now, I have seen that repeatedly, and that is the case of real estate investors. They own assets. They like to think they own equity, and maybe sometimes more. They think they have more equity than in actuality they have, especially if they're selling under a duress or extra stress that equity is not near perhaps what they think it is. So they can be asset rich in their mind, but cash poor. Uh, Cash poor is not comfortable to certain people, and it never was to me, and it's certainly not a asset with spouses. I can tell you that for a fact. They'd much rather see liquidity out there than just equity in properties. They don't value that. They don't. They don't. They're not comfortable with it. They want something besides just an asset that you're holding. They will greatly discount it, by the way. Whereas banks, they think they want both. They want asset rich with their mortgages, and they want cash rich. Always been that way, friends. I've always been that way. And if I have $1 million of debt, I want $500,000 in cash, or or very liquid that liquidates into cash fast. I want that also, and as soon as possible, I want to be 1-to-1, and I want to have the liquid equal to $1 of debt. I'm a lot more aggressive. I'm a lot more confident when I'm in that kind of position, and I think you will be too. So it's something to consider. Do you want to be in like that, or do you want to be at extreme amounts of debt with a little bit amount of cash? So be asset rich and cash rich is what I'm a proponent of. And I see no reason not to have all the assets that you want and can take care of. Just have an equal amount of cash. Too. Think of some of the guys like Mr. Kiyosaki, and one of my favorite. I like Grant Cardone, and Grant's very much that way. But Grant could have all of that real estate that he has and have near an equal amount in cash in tax shelters also. And I think he would be even more powerful and a better example if he did have that type of structure. Have all the real estate he wants. Just pile the cash up equal to it and continue to borrow the money. It's fine, but have a 1-to-1 like the banker does. The banker has. And now the bank can get into trouble because they can have 10-to-1, in federal lending. Another thing, investors must have good credit and financials to qualify for loans. I know you would say that's exactly the case. They must have good credit. They protect their credit, and their financials have to look really good to get a loan, which means oftentimes they're turned down for loans. They don't qualify for the loan, and they're at the subservient of the bank. Will the bank go along with them or not? Bankers need not have good credit or financials. Why? Because they have the collateral, the cash and collateral to put up. I've commonly bought, and always from the beginning, even more so in the beginning, bought real estate borrowing money from insurance companies. I have borrowed from them. I've never so far in 144 deals, which is not super, I realize, in my career, but it's a good amount. 144 properties to this point that I've had flow through my hands. I've never borrowed so great of money that I didn't have collateral cash backed up. And I've never borrowed one through a mortgage company. I've never financed through a mortgage company to this date. And I didn't do that intently or intentionally, even. It just worked out that way, and but consequently, I've never paid closing costs when I've bought real estate because insurance companies do not charge closing costs. Not any of them. The nuisance fees. I mean, not any closing costs you can think of. The recording fees, the surveys, the appraisals, the inspections, all of these things that can add up to be thousands of dollars. I've never paid that when I've purchased real estate. Almost did once, and got a HUD statement leading into it from my banker. He asked me about it a couple of years ago, and this was 20 something years ago when we discussed a loan that I was shopping for at the time. But he sent me a HUD statement that showed almost $26,000 in closing cost and for a home, and I couldn't pay that. I couldn't force myself to pay that. I tried, but I just couldn't do it. I was so unused to paying it, and I wouldn't dare go and pay that. And so I borrowed the money from an insurance company, which gives me a guaranteed loan, that I pay at 4 to 5% interest, and I pay it very flexible. By the way, I don't have to make a payment till the end of the year. If I'm paying for it with investment money and investor dollars, then I can delay that all the way up to a year, and then pay it back. So or start making payments. I can pay it amortized, just like the banks do, 5 years, 10 years, 15 years, whatever I want to amortize it at, and I have a great flexibility. And then if I don't make the next month's payment, I'm not turned over to credit reporting agencies. So if you want to know how I do that, call me. Call me or drop me a email, and I'll be glad to touch base with you and give you an explanation of that. So bankers need not have good credit or financials. So I mean, I want good credit, but I don't have probably the highest I could have if I paid a lot of attention to it, and I don't, because I know I'm guaranteed a loan. I've never lost a property because I couldn't get money. I couldn't borrow money. I've never lost one. Not many investors can say that. Really can't. And so, being a banker mindset versus an investor's mindset, I think will help you, or at least try to have some of the banker's mindset. And as you go down the road, you'll be a lot more solvent, a lot more at peace, and your spouse will like it a lot better, and your partners will like it a lot better. And when they all find out that you have the ability to close loans, they'll bring you deals, piles of deals, that they cannot handle because they can't get the money. They can't get the amount of money. Well, I'm going to